Hello, hello, and welcome to another episode of the Awesome in Seattle podcast. This is your host, Christian Nossum with the Awesome Nossum Group at Wilson Realty. And today we're talking about credit scores, how to increase your credit score, how to potentially use your rental payments and utility payments to increase your credit score, which will increase your ability to purchase a house, possibly even lowering your interest rate, which is just going to make things less expensive for you. And today we have an awesome special guest, the one, the only, Mr. Dan Keller.
I thought you were going to say Joanna.
I've said that before, I'm sure.
The one, the only. Yeah. No, it's good to be back. I think it's been a while.
I think it has, yeah. So Dan Keller is, who are you, Dan? Why don't you explain who you are and why you're an expert in this subject?
Well, I'd say I'm the right person to talk about credit scores. So I'll give you a real quick 1 minute overview of my career when I started in the mortgage industry, literally right before I met you, Christian.
Yep. Almost
19 years ago.
Yeah.
I was coming out of 2008, 2009, the crash, right? And so there was a lot of people that had adverse credit reporting, things on their credit report that weren't great. We were going through a financial collapse. And so the first 4 or 5 years of my career, I fixed credit. I mean, it was the only thing I could do as a mortgage professional to help people get into a home. So I have a background in repairing credit and fixing credit. Then I got actually established and kind of busy. And I'm like, I got people that really want to get mortgages. I got to, so I went and found a couple of different credit restoration companies that are credible. That's the key word there when you're looking for them. We'll talk about that later. And then, as technology's evolved, a lot of the stuff, Christian, and we're going to talk about this a little bit more here in a few minutes, we can do in-house now with AI and with technology. So this is going to be a fun podcast. But yeah, local mortgage professional, background in fixing people's credit. Probably, I don't know how many credit reports I've looked at this point in my career, but probably hundreds of thousands.
Yeah, a lot.
A lot.
Yeah. We also have another special guest, Miss Joanna Beecher.
It's
there
me.
She is.
Hi, guys. Yeah.
She is an agent here, also on the Awesome Nossum Group. So, Joanna, let's let you start asking some questions.
Okay. Well, I want to start with the basics, right? I mean, no place better to start. So, why should someone care so much about their credit score if they're thinking about buying a home, Dan? Well,
Christian said it in the intro. It really, so the first domino in the whole home buying experience is looking at your credit. Mm-hmm. It's the first thing a lender's going to look at. It's one of the first things that we need to pay attention to as consumers too. Even if you're not trying to buy a home, it's a necessary evil if you want to survive financially in America.
Yeah.
So first and foremost, it's the first things that lenders look at when buying a home. Number two, Christian said this too. It's primarily the largest factor that impacts the rate that you'll get.
Okay.
Yeah.
Important.
So it isn't just about getting approved, it's getting approved with the best possible terms. And when I say terms, I mean interest rate, down payment amount, all of those things. So if there were two different buyers, Dan, that had similar incomes, if their credit score was different, how would that affect them?
Well, let's look at it this way without having an exact scenario, but this is how it could look, Christian. One could end up using, for example, an FHA loan that has a lot of government fees, FHA fees, a 1.75 funding fee attached to the loan, higher private mortgage insurance per month, okay? Versus that same person that has that good income, or the same income, if you will, but has that better credit score, might be able to get a Fannie Mae or Freddie Mac backed loan, 5% down conventional loan, which doesn't have that 1.75 fee. So let's just say an $800,000 loan amount. It's over $10,000, way over $10,000 in fees.
Wow.
Right? So I would say, without having that scenario one is X, scenario two, like a case study, just looking at it that way, it's that big of a factor.
Yeah, that's huge. That's huge. So you can do some things, and that's what we're going to talk about today. You can do some things to increase your credit score that doesn't cost you anything more. And you're probably already doing a lot of them. So let's break down how credit scores are actually calculated so that the listener can get a better idea of what's going into this.
Yeah, if you're listening to this on the podcast, you're just going to have to listen really well. If you're watching this on YouTube, I have a really cool pie chart for you to see the 5 factors that truly impact your credit score. So first and foremost, the biggest one is a no-brainer. It's your payment history. Yeah. Just if you make your payments on time, you're going to have a better credit score. So do everything you can to make your payments on time. Now, this is where I will tell you this. Hey, life happens and we all go through different phases in our life. I certainly did right after graduate school. I was like, I don't need to pay back these student loans. And then 3 years later, I wanted to buy my first home. And I'm like, shoot, I should have paid those.
Should have probably paid those.
So I had bad credit starting out in my home buying, my first time home buying journey. So if you had made some mistakes in the past, the really cool thing about this credit scoring algorithm that we're going to talk a lot about today, it has a short memory span. Okay. So it's really, what have you done for me lately? So in the last 12 months, if you've made your payments on time, keep doing that. So number one is payment history. Number two, which is right behind it. So number one, payment history is about 35% of your score is based off of that. Right behind it in second place, 30% of your score is your level of debt. Think of it this way. You have a $10,000 limit on your Visa card, your credit card. If you get over, $7,000 to $8,000 of a balance to that limit, it's considered already maxed out, close to being maxed out. So that's going to hurt your credit score. Now, there's been a lot of legal trials and studies on this where they'll say anything under 20%, so a $2,000 balance with a $10,000 limit, it has zero impact. So people are always like, should I pay off my credit cards to qualify? No, you don't necessarily need to do that. So your level of debt, your balance to limit ratio is in second place, okay? Now, the next three factors really don't make a huge difference, but they factor into it. The third one is utilization. This is at about 15%. Think of it this way. You have a mortgage, you have an auto loan, you have a couple of credit cards, you have a student loan. So that's kind of like your types of credit, different types of credit at about 15%. Number four, lengths they've been open. So this is important. A guy like me who's had multiple mortgages, multiple car loans paid off and boat loans paid off. So I've got deep roots with my credit history, okay? I could, which I will not do this and I don't want to do this, but I could literally miss a credit card payment next month. I wouldn't go as far as saying missing a mortgage payment because that would have a more severe impact, but I could miss a credit card payment because this has happened over about 3 years ago. I'm not going to throw my wife under the bus, but she does pay our bills and one got overlooked, and it's my fault, by the way. One got overlooked and I'm like, oh my God, your US bank payment. My credit score literally went down like 18 points because of the deep roots. So if your roots are deeper, you're going to have less impact.
Of paying on time.
Yeah, which most of our clients, first-time homebuyers, and people may possibly listening to this don't have those deep of roots. So length of accounts is really big. And then the last one, which I get this almost with every single client. Are you going to make a hard pull or a soft pull because we don't want an inquiry? And I'm like, well, it's like you not wanting to go to the doctor because you don't want a doctor to like have you maybe take your shirt off or whatever. You got to do it. Okay. Yeah. You guys, you just have to do it. The good news is we don't initially start with a hard pull. We start with a soft pull. So it doesn't impact your score, but a lot of people seem to be really worried about these inquiries. Just a quick reminder, your mortgage lender or bank is not like a car dealership. When you go to get a car loan or buy a car and you go to the finance department and they shop you around. They shop you around so they can make money.
Yeah.
So they're gonna go take you to 10 different banks and they're all individually gonna pull your credit for the car loan. That hurts your credit score. What we're talking about here doesn't. So a mortgage inquiry is not gonna have a big impact. But those are the 5 factors right there, you guys, that impact your scores.
Yeah. So traditionally, things helping your score have been like credit cards, car loans, student loans, and mortgages.
Yeah, get a mortgage and pay on that for a year, and you're going to see a massive bump. That's a big one.
Love that.
Yep.
Yeah, and the funny thing, one of those things doesn't usually help your credit get built at all if you haven't bought a house yet, and that's your rent. But there's some changes.
To me.
Yes.
Sorry. I'm like, we worked so hard. I used to for many, many years of renting. You work so hard on being a good renter and paying your rent, and it just felt like
you got no credit for it.
Yeah, nothing.
Yeah. Well, that's where things start to get interesting because now you can start to get some help with that or have that help your credit score. Do you want to talk about that, Dan?
Yeah. So there's companies that you can subscribe to that will actually report to the bureaus for you. We have seen some property management companies report to a bureau. So we're starting maybe to see some more of that. And then down the road, we're seeing a new credit reporting algorithm, Vantage, that's coming in where we can upload your rent history of VOR, your verification of rent, to that and have them report as well. That's going to be, I don't want to go too deep in the weeds on the whole Vantage scoring because that's still in beta right now. And mortgage companies and Fannie Mae and Freddie Mac are working through the kinks there. But I would say come and talk to us again, end of 2027, and we should have a better idea of how that looks in the mortgage industry.
Great. If it can help people, I love that.
Yeah.
And it's huge. Because as you know, we work with first-time home buyers all the time who have rented for years, and they have a perfect payment history, and it doesn't get to be utilized. But they've demonstrated that making those payments is something that they're absolutely capable of. But historically, that hadn't been helping them. So that is good news that it could.
Yeah, we've identified, just if you're listening and you want to look up a couple of the companies. I've heard of Rent Reporters, probably your most common, and I don't even know how to pronounce this right. Yeah. But Isuzu. ESUSU. But there's also Rental Karma, Boom, and Self's rent reporting program. I would go, if you need to do this, that's one thing, but I talk to a mortgage professional first to see if this actually impacts your ability to qualify for a mortgage. What we've done is we've actually helped people with this before. So if they're going to charge you for stuff like this, maybe we can do it and save you some money, stuff like that.
Because these things do cost money. They're not free. And if it's not going to help you increase your credit score at all, like if you're close to already having a great credit score, don't spend the money. I mean, they're generally anywhere from, after just super basic research that I just did, anywhere from $25 to $100 upfront, plus anywhere from like $7 to $25 a month, every single month, to get this to continue reporting on your credit.
So you'd really want to make sure it's worth it. I guess at this point to even do that. But
so talk to a lender first, talk to Dan first, and then see if it's even necessary to do it. But if it is, it's great that is an option. He might be able to help you without having to go through these companies. But if he needs to, he's got these in his back pocket as well.
Do you know that if maybe somebody's just renting from an individual landlord, if it could help them there, like not a big management company?
Yeah, I mean, you're just going to provide these companies or us proof of rent and that you've made the payment. So oftentimes they're going to ask for 12 months cancel checks if people still write checks, or proof of I mean, or just proof of payment, right? And then you'll get the ledger from the landlord. Obviously they'll keep track of that too. So again, I think Christian's best advice is talk to a mortgage professional like myself to see if you even need that. I'll just be very, very clear. I'd say probably 1 out of 200 of our clients, actually, we need to do something more than what we see on paper with their rent. So it's not always necessary. But if you have a 0 credit score, for example, and this impacts your ability to qualify for a home, start with us, and then we can kind of direct you.
Okay.
Who's the ideal candidate for this? You just said someone that probably has 0 credit or very, very minimal credit. What else?
Yeah, I mean, if you're a disciple of Dave Ramsey, I mean, he tells you don't take on any debt and don't use credit, which I think a lot of the stuff that he talks about from a budgeting standpoint is good, but a lot of the other stuff is like, come on, man. I did a video not too long ago where I actually, because we can do a mortgage with 0 credit score. And if you take the difference between the rate and the fees associated with a home loan with a client that has a 0 credit score versus someone that has like a 640 or a 660,
which is somewhat low,
which is still low. Big difference in fees. Wow. So basically I challenged him. Obviously he did not get back to me. I tagged him on social media, but I said, I'm challenging you that you would rather your clients pay more fees than to spend a little more time building credit history, which just because you have a credit score doesn't mean you have debt.
No.
I mean, have a credit card and pay it off every single month.
Yeah.
There's no big deal. I mean, strategically, we like to encourage, I think you did a podcast on this where, you live off of maybe a credit report, or a credit card that gives you airline miles, right? That's saving you money.
Yes.
It's not hurting you.
There's a lot of great credit cards that you can use points.
Yes.
For other things, and it's actually very helpful.
We did that paid for our entire family of 5 Europe trip last summer.
It's more impressive than what it helped me with last weekend after the Gorge show. I got to stay at Suncadia.
There you go.
So I would just say be cautious of who you're getting your advice from. I'm a huge advocate of carrying no debt, right? Paying off living within your means. But some of that advice, one size doesn't fit all. Number one. Okay, who's the other client that this would be kind of applicable to? Someone that's newer maybe to the country, right? And starting to build their credit score here in the US. Or someone that's just younger, maybe right out of college and never really had credit cards and anything like that. So that's again, when you sit down with a pro, I think a really good mortgage professional is going to sit down with you and say, okay, hey, this is what I see. Let me help you get to more favorable terms, and this is how we're going to do this.
Yeah.
Okay.
Let's talk about another category that most people don't realize that they can get help with.
Utilities.
Yes.
How does that work?
It's along the same lines, almost identical. What you're going to do is you're going to take your utilities and you're going to reach out to the bureaus through these entities or through a lender, and it's the same thing. And we're going to show that you've paid. Same thing though. We're going to want more than a 12-month hiry of you making those utility payments. Yeah. But along the same lines as well.
Pay those utilities on time.
Are there any other examples that companies that can do this too, especially when it comes to utilities?
Off the top of my head, that we've used, we haven't really had to. Okay, rent, but I will give you the names of a couple. Experian Boost, I think it's experianboost.com, ultrafico.com. These are a couple of them. Research them, but again, before you go out and subscribe and start paying money to companies like this, where you may not need that, it's just better that you talk with a pro first.
Yeah.
Because
again, you might not even need any of this stuff.
Yeah.
Don't spend money that you don't need to.
Yeah. There's some other hacks. If you're looking to just build your credit score, there's some credit cards and some strategies that I can get you. And I don't want to go into detail today because it'll be off topic, but if you needed a credit score within the next 2-3 months, between getting a secured credit card and then there's some services online that you can pay for that will start reporting immediately. And you just put $250 into that account and it starts reporting to the bureaus immediately within 30 days. So there's some strategies there. I think that's the bigger picture. Like you would do this to get a credit score. I don't think you're doing any of this stuff to qualify for the home loan because oftentimes we can just do this manually. Give us your most 12 months recent cell phone bills, stuff like that.
Yeah, and the nice thing about doing that, if you do need to do it, it's not costing you any more money. It's getting you credit for what you're already paying every single month. And that's kind of why I wanted to bring this topic up, because if you are in a place where you don't have a very good credit score, you have no credit, and you are trying to build that up, these are some options that you could potentially use to increase your credit score. Let's switch gears a little bit. Let's talk about things that you should not do in terms of your credit score. So ways that you can hurt your credit score. Let's talk about those. What's at the top of your list there, Dan?
So debt consolidation. So the bureau is very, very, so you have to look at it this way. The bureau is going to look at you, Christian, as they're going to assess you as your ability to not repay the debt, but your likability to default on the debt. Okay. So if they see red flags, high balances, low history, a bunch of inquiries, those are red flags that you're in trouble. Okay. So I would say payday loans.
Yeah.
You're in trouble if you're getting a payday advance.
So true.
Financially in trouble, according to the credit reporting algorithm. So payday loans, I dealt with this with a family member about 10 years ago, where I didn't know this, or I would have helped them out financially myself, but they enrolled into a debt consolidation company. That's almost as bad as a bankruptcy on your credit report.
Oh, wow.
Yeah.
Wait a minute. Is that like a SoFi loan?
No, well, I don't know what a SoFi loan. I know it's a company. It's a private third-party company that you pay them a fee, an upfront fee, and then a monthly fee, which comes out of your monthly debt payments. And they pay off all of your debt, but now you owe them, and they settle it. What they end up doing is they settle it and stuff, but it's bad. It's bad for your credit. Yeah, it's bad for your credit score. Those are the top two things. Some of the other things I'd say, we talked about it. Don't max out your credit cards. Don't live outside of your means.
One thing I'll jump in real quick, because I know this. If you are, say you're just paying off your credit card every single month, and let's say, again, using the same example, you have a $10,000 limit on your credit card, and every month you're spending $9,000 because that's just what it costs to live and whatever, and you're paying it off every single month. That's good, but also could be bad because it looks like you're using your max every single month. You can actually go to your credit card company and ask them to increase your balance, your credit card balance, even though you're not necessarily going to use more. If they increase it, say they double it, now you're only at 50% or just below 50% usage. and your credit score is going to improve because of that.
Yeah, that's an easy phone call to you guys.
Yeah.
Ask them to raise your credit limit. Let's say it's at 10,000. Just ask them to raise it to 15 or 20. And then, or if it's at 5, ask them to raise it to 10. And that makes a world of difference.
Yeah. Yeah. And it doesn't cost anything. It's not a scary conversation to have. They want to actually increase you because they want to make some more money off of you, because they're hoping that you, because they hope that you don't pay it off every single month. So then you have to pay interest, because they love that 20% interest every single month.
Yep.
Yeah. So
I would too if I was them.
yeah, but don't do it if you're just going to have an ongoing balance. Like, that's not the smart way to go about this. Just pay it off every month and stay within your means for sure.
Anything else people should avoid?
Yeah, I would say as a youngster or in general, co-signing is very risky. So we see this a lot where people co-sign for their partners, or friends or family members. Again, talk with a professional first, because why are we co-signing? Is it to raise your credit score? Okay, cool, that's fine. Is it to help someone out and help them qualify for debt? Well, now you're responsible for that because you've co-signed. So there are some things that I would rather loan somebody money. Like for my kids have a credit score. I've helped them build a credit score. I will give them money for a down payment versus co-signing on a home.
Yeah.
That's my philosophy. And plus, I want them to have that debt. Yeah. I want them to have that mortgage and own that. And if they get into trouble one day, they can come back and maybe ask me for some help, but I'm not on it with them. It's 100% theirs. So be careful with co-signing.
Yeah. Let's talk about some of the videos that we see on social media promising crazy 100-point score increases overnight. What do you know about those? Have you looked into those at all?
Yeah, I'm seeing a ton of it, and it's starting to burn me out a little, because I was an early adopter to social media, and now it's all about the likes and the views, and then how many can I get so that I can get a company to pay me money for those likes and views. When it comes to making the largest financial decision of your life, identify a pro in your community. I would, versus going online and getting some advice from a reel that went viral. Some of the stuff has merit, but if it seems too good to be true, it probably is. 100-point increase overnight. If I could get you a 100-point increase overnight, I would do that. I can get you big increases overnight. If I look at your credit report and you got 3 accounts that are maxed out, for example, you paying each one of those down to about 20 or 30% is going to give you a 50 to 100-point raise. So that video you just watched could be a nothing burger. But if they're promising other things, then I would just be cautious of that. Again, we're going to cover some really great things today that are the fundamentals. Outside of these fundamentals, a pro like Christian and Joanna and myself are going to know some of these quick fixes. So I would just be cautious. Like I tell everyone, be cautious. Mortgage, real estate, stuff like this that you see online. Run it. You got to have a good filter to run it through, and that's a local pro like you guys.
Yeah. Well, everybody wants the magic pill.
Yeah.
Fixes everything.
True.
Or the magic formula. And it's like, there's so many people working on all of the things all of the time.
Yeah.
If it was there, we'd probably know about it.
Guys, I was a sucker for this last year. I threw out my back, had a herniated disc, and I'll tell you what, once the algorithm sees what you're looking at, you're exposed to it all the time. And I can't tell you how many, and I subscribed to a couple of these trainers and these fixes because I was so desperate to be healed. Right. And I think people, when they want to buy a home and they might have bad credit, they're so desperate to get their credit score up that you'll fall for anything. Right. Yeah. So just be cautious. You're listening to 3 people that know what they're talking about. I'd say start with us and then see who we recommend you to.
Yes. And I can say from personal, just recently I've just bought my home not that long ago.
Yeah, almost a year.
It's coming up on a year almost.
Yeah.
Well, November.
Ish, yeah.
But I wanted it so badly. I wanted it so badly for years. And the amount of just that hunger that you have of wanting to speed things forward, I was just losing my mind a bit. But the problem was there is no quick fix for something that I took years to establish, which was, certain debts that I had to pay down. And you just have to be steady. It's those consistent habits of, making good decisions financially.
Well, that's what the credit bureau wants to see. And I think that's the whole point is you have to have consistent history showing on-time payments. That's really what they want to see.
It's adulting, really.
Yeah,
and
it's just adulting 101.
Really not into that for a very long time. But I will say I started that conversation with Dan 2 years.
Over 2 years ago.
Yeah,
Totem Lake Starbucks, sitting out in the sun. I remember that with you. Well, we built a plan.
We did.
Yep.
And then you followed it.
Damn it, this is going to take 2 years. Oh, and it was, but I did it. And I'm very happy that I did. So you can do it.
We've met so many people over the years.
That it takes a couple years or more.
Yeah, we've done the beers and home buying class every month for over a decade at this point. There's been thousands of people that have come to this class. Yeah. We've helped hundreds of them successfully buy. And most of them are 2 to 3 years out. They're not like ready to buy next week. No. And the whole point of it is to start the educational process where you just start, and then we have a one-on-one meeting, which is not scary. Most people are scared of this one-on-one meeting because that's the next step after the class.
Because we're terrifying.
We're so scary. But the point of that meeting is to give you a reality check. Where are you right now? We don't care if you're 3 years out. We'll help you build a plan so that in 3 years you can do it. And then we'll check in with you every once in a while, every year or so, and see where you're at.
Well, and you guys continue to create content like this often that people that come to our class get to actually learn and develop over that 1 to 2 year period too. So
it helps keep you consistent, right?
Yeah. Yep.
It's like that check-in point, but that is one of the things that I valued in that time is whenever I did have a question or, needed to touch base on anything, financial, I knew I could go back to Dan. I could go back to his team. And it made all the difference in the world. And you can do that too.
Yeah.
So before we move on to some tips on how to increase your credit score, I do want to throw out some things. So if you are in the process or about to buy a home, there are a few things that you should not do. And those things are things like opening new credit cards, financing furniture, buying a car, or even moving money around or cashing out things, which they could actually hurt your qualifying ability. So if you're going to do any of those things, lean on your lender to help you understand if you can or cannot do that, because it could actually put you back numerous steps and delay your purchasing process. So,
I have a packet called the do's and don'ts when applying for a home loan. And a big part of that is, don't apply or open up new credit. You're going to get, depending on the time of the year, and you might need appliances. You're going to walk in and 0% interest for 12 months. That's a really, really good offer, right? And that can save you some money. But if you were to apply for that right before your mortgage funds, that could throw things off. Same thing. Don't be afraid to talk to your lender. Yeah. People ask me all the time. I get texts over the weekends. They're like, hey, we're here at Judd and Black and we're blah, blah, blah. And I'm like, hold on real quick. So let me look at your debt ratio. Let me look at your credit scores. If there's a buffer there, you're fine. But if there's not, it could really get in the way of it. Yeah.
Okay, let's move on. We're going to talk about some rapid fire ways that you can quickly increase your credit score, probably not by a ton, but somewhat. So as someone that wants to buy a house in the next 6 to 12 months, what should they focus on, Dan?
Yeah, so I think you just hit it right on the head. Is it 6 or is it 12 months? If it's 6 months, there's not a lot we're going to do in 6 months other than maybe paying down some debt, okay? If it's 12 months, maybe depending on, this is a good opportunity really to kind of go a little bit deeper. When you're working with a pro, we have this software at New American Funding that I love. It's AI backed, but it's a credit analyzer software. I can internally upload your credit report to that, and I can put in the ideal credit score that we're trying to achieve, and it'll tell us exactly based off of your credit report, exactly what we need to do to get you to that ideal score. So I would say start with something like that versus guessing, okay?
So that could scare some people because if they didn't actually hear what you said, but they heard upload your credit score or your credit to AI and ask it, that's not a good idea at all.
No.
Don't do that.
Don't do that just on your own.
Don't do that.
That's
Lean
why
on Dan.
The key word I said internal. We have this internal.
Yes.
And it's proprietary to us. And again, there is no credit. We're uploading your credit profile, not your social and stuff like that, or account numbers. But that's a great point, Christian. But that's a great place to start. Start with a pro to get great feedback on what you should do in that time period. That will tell you what to do in general. Like we talked about, just go back to that pie chart. Make sure your account balances are paid down to under 20% of the balance to limit ratio. Make sure your payments are on time. I would say probably don't go out and open up new accounts in the meantime. But I would take more of that thorough, customized approach going, all right, I think we always tell people in our strategy calls after the homebuyer class, our strategy sessions, where you're sitting with Joanna or Christian and myself, and we're talking about their goals and their unique profile, buyer profile, and their timelines. A lot of the times we say, if you're 6 to 12 months out, start the process now. It's not going to hurt you.
100%.
Have a pro look at your credit and your income and your assets.
And how many times have people listened to us and pulled it a year out and they're like, what the heck is all this stuff on my credit? That's not mine. I didn't do that.
Right.
How many times do you see that a week, Dan, where there's something on someone's credit that isn't actually theirs?
Yeah, misreporting. It's probably 30% of all applicants have something that they didn't recognize, or they're like, oh, crap moment. Oh my gosh, that was from an ex, or that was from 10 or 15 years ago. And I was like, well, it's there.
Yeah.
So.
And if you have time, you can clean those things up. But if you're doing this, if you're waiting until the last second because you don't want that hard credit pull or whatever, you could be screwing yourself over and costing yourself a lot of money. And
that's like one of the biggest takeaways of this whole podcast episode is like, you don't have to guess.
Right.
The sooner you get in, the sooner you're just thinking about buying a home and you feel like it potentially could happen, talk to an experienced local lender.
Yes.
And don't guess. Make a plan. The earlier the conversation, the clearer your pathway gets and the better steps you can take.
Yep. Exactly.
I think I'll kind of put a button on this. A lot of lenders aren't willing to put the time in to advise people on their credit. Number one, because they don't know. Number two, they're not a professional. Where I've been teaching first-time homebuyer classes with you since I started in my career, right? That's kind of an obligation that we have. Everyone that comes to our classes are not ready to buy next month.
No.
2, 3, 4 years sometimes. And so taking that bigger picture approach and that perspective that let's help you right now and let's build a plan. That's what we do. A lot of banks and lenders just won't do that. And so that's where Joanna says, talk with a pro, someone that's local and willing to do this. Because one size doesn't fit all. AI is not going to necessarily help you, and neither will a reel on social media. So just be cautious there. No.
Awesome. Well, thank you so much, Dan, for coming in and sharing some very helpful tips and do's and don'ts and things like that with us today. Just helping people feeling more confident with building their credit to be able to get into a home is so important. And I'm excited for whoever's listening to come and see us, myself, Christian, and Dan, at our next Beers and Home Buying class, or keep listening to the Awesome in Seattle podcast. But, I think this is a great first step for a lot of people, too.
Yep. And if you are interested in attending one of our free homebuyer classes, you can just check it out at beersandhomebuying.com. We host a class every single month other than December. So check the website to see what neighborhood the next one is in. We host them at different bars and restaurants all throughout the greater Seattle area. So definitely, if you are interested, check that out. If you are hoping to do it sooner than later, you might want to travel to wherever our next class is. And if you're willing to wait till we come to your neighborhood, then just see and keep tracking. So that's it for this episode of the Awesome in Seattle podcast. Thank you so much for listening. Thank you, Dan, so much. Do we need disclaimers at all?
Let's do that real quick to keep us legal. I am a mortgage professional in the state of Washington, so I do need to disclose my license number. It is MLO number 115349er. 349.
Yes. And all of the products that we talked about, we have not vetted any of those, so use them at your own disclosure. We didn't vet these.
Like you said, talk to a pro first. That's the good place. That's the best place to start.
That's the number one place to start. And then if you do need to do something, listen to Dan and do what he says because he knows his stuff. So,
and share this episode with a friend.
Yes, please. If you think any one of your friends or coworkers or family members could benefit from this, definitely share that with them. Thanks so much for listening. We'll see you next time.
Bye.
Bye.